Today's episode of Rise High Facebook Live. Really glad that you can join us today, and we've got an awesome show planned for you today. Today we're talking all about property investment in a self-managed super fund, and I'm really excited to be joined by Chris and Kristen. Thanks for joining us, guys.
You're welcome.
I believe for both of you it's the first time doing Facebook Live, is that true?
That's correct.
Yes, so should be fun, should be interesting. Before we get started on the topic, just a couple of things I wanted to share with you. We're really excited this week because on Thursday night, our sister company, Rise High Accounting Solutions, is actually being celebrated as a finalist for Accounting Firm of the Year at the South Australian Accounting Awards, and also Customer Service of the Year. So we're super proud of our sister company, Rise High Accounting Solutions. They've been doing really, really well over the last year and have been delivering some great outcomes and results for clients. So we're wishing them the best of luck for Thursday night. We've also got our last property investment seminar coming up for the year, and that is on the 14th of November. That one there is specifically for business owners that are also interested in building a property investment portfolio. Sometimes for business owners it can be difficult drawing that fine line between, I guess, maximising their tax deductions as a business owner, but also building the property portfolio of their dreams that will help them to achieve their long-term goals. So that seminar is all about finding the right balance and how they can achieve their business goals, their personal goals, and their property investment goals. So if you're a business owner interested in property investment, definitely register. You can go onto our website and register for that now. We do already have registrations open, and we have sold out of most of the seats there. It is a free event to attend, but definitely if you're interested, get in soon. The other thing I wanted to mention was that my book, The Rise High Investor, we are launching it on the 1st of November. It is available for pre-order at the moment, and the pre-order price is reduced to $14.95. You can check out more information about this property investment book at risehighinvestor.com.au. We also have a Facebook site called Rise High Investor, and thank you to everyone who's ordered a copy so far. Really excited about that and hope it brings you massive value. And yeah, if you're interested in property investment, definitely grab a copy before it goes up to full price. Okay, so getting on to our topic of today. And look, we actually have had lots of questions on this topic. It is a topic that a lot of people are interested in. So I've had lots of questions that have already come through, which I'll definitely get all the answers to for tonight. But you still have a chance to ask questions. If you haven't had a chance to submit your questions previously, please feel free during this session to email amanda@risehigh.com.au, or you can write a comment in the comment section of the Facebook live stream. We'll be running until about 6 o'clock tonight, so that gives us about half an hour, and we would love to hear from you. If you have a comment or question about anything we're discussing, please feel free to put it in the comment section. So let's get on to the fun topic.
Righto.
Property investment through self-managed super. So firstly, let me just introduce our guests. We've got Chris. He is the managing director of a great company that specialises in self-managed superannuation called Excel Super. He's a bit of a SMSF whiz, so we're really happy to have him here. And Kristen, she's one of our wonderful Rise High mortgage brokers. Now, all of the mortgage brokers at Rise High do have special skills and experience in providing advice about loans and mortgages to do with self-managed super funds. And Kristen has had a lot of experience in this area, so I thought it'd be great to invite her along so she can share with us some of the lending side of how a self-managed super fund property loan works. So I'm going to start with you, Chris.
Okay.
Really basic question.
Yep.
What is a self-managed super fund?
It's good to start with the basics, isn't it? Well, a self-managed super fund really, Marissa, is no different than any other superannuation fund. It simply has exactly the same benefits and the same rules and conditions that apply to any other superannuation fund, with two fundamental differences. The first of those differences is, rather than a retail or industry superannuation fund having a trustee that makes all the decisions for the members about how to invest and what occurs within the superannuation fund. A self-managed superannuation fund has its own trustees, being you, the investor. So the first fundamental difference is that you would appoint yourself to be responsible for making all the decisions about what happens within your self-managed superannuation fund. Hence the reason why it's called self-managed.
So basically, just to say that in another way,
Yep.
instead of someone in Ivory Tower in Sydney making the decisions
Yep.
on how your superannuation will be invested, you get to make the decisions about how your superannuation is invested.
That's absolutely correct. So essentially, one of the catch cries of the self-managed superannuation community is that you get to take control over your superannuation and get to do with it what you want to do. The second fundamental difference is that a self-managed super fund, unlike any other retail or industry superannuation fund, has a maximum of 4 members.
Okay.
Yep.
So it's more a family.
Absolutely.
It's more for the benefit of the family.
Yes, it is. And the most common outcome is that a husband and wife, a couple or a couple of business partners can go into a self-managed superannuation fund together and combine their balances and use the strength of a combined balance to be able to do things that perhaps they couldn't do on their own.
And I guess one of the other fundamental differences between a self-managed super fund and a normal retail or industry fund is, of course, the fact that through a self-managed super fund, you are able to buy an investment property.
Absolutely. So
and borrow money to buy an investment property. So can we talk about that for a minute?
Yeah, sure. In actual fact, in any super fund, if the trustee was to allow it, anybody, any super fund could buy an investment property, whether or not it be commercial or a residential property. It's just that normally what happens in retail and industry superannuation funds is they restrict their trustee to prevent people from doing that. Now there's many reasons why they might prevent people from implementing that strategy, but certainly in a self-managed super fund, because you're in control of the decisions and the investment strategy, it means that you're free to be able to purchase an investment property, whether or not it be commercial or residential, whenever you want to.
Yeah, awesome. So a quick shout out to Glenn and Rue. Thanks for joining us, guys. Really appreciate you tuning in. And so let's just summarise for the viewers the pros and cons of a self-managed super fund. So firstly, let's talk about the pros.
Yes.
Obviously, the first thing that comes to mind based on what you just said is control. The ability for you to be able to control how and where your money goes.
Yes.
The ability to buy property.
Yes, and there are other pros as well in regard to self-managed superannuation funds. One of the statistical tidbits that's coming out of the marketplace at the moment is something like 97% of people with $400,000 or more in superannuation, and that can be when you combine it with your partner.
Yep.
97% of people who have 400,000 or more are now in self-managed super, and the
Okay.
reason for that is because of the economies of scale that it creates and the fixed flat fee nature of self-managed superannuation fee structure. So it becomes very economical to run a self-managed super fund with larger account balances.
So that's really interesting, because I think I was going to say on the flip side, when we talk about the negatives of a self-managed super fund, I think there is a perception out there that they can be quite expensive and costly to set up and run. But as you've just said, that's not always the case, that sometimes it's actually cheaper to run a self-managed super fund depending on the circumstances of the individuals, I guess.
That's correct. I mean, it's horses for courses, but we have a very strong view at Excel Super that you really need a healthy balance within your superannuation fund to justify moving to a self-managed superannuation fund. And what I mean by healthy balance is you need somewhere in the somewhere approaching $200,000. And again, remember that don't be frightened by that, because you can combine it with 3 other people to make up that $200,000.
Yeah, okay.
And the average account balance of superannuation across the nation is about $75,000.
Yeah.
So even
okay.
husband and wives, on average, have $150,000.
Yeah. So that's really interesting. So I'm just going to get us back to the pros and cons. So I think we've covered the pros. So obviously control, the ability to be able to buy property, and cost. Maybe
could be a pro
or a con, depending on what your situation is. But if that's probably the pros in terms of comparing self-managed super to a retail or industry super fund. But if we now considered comparing self-managed super fund as an investment vehicle to purchasing an investment property in your personal name or in a trust outside of super, there are also some tax benefits, I believe.
Yeah, well, one of the most important things for us to understand about super, and Marissa, as you know, when we talk about this subject at the Rise High seminar with self-managed super, we talk about the fact that superannuation is not an investment, it's just simply a blank tax structure. It's a trust with a concessional taxed environment. Superannuation is taxed at 15% as opposed to our marginal tax rate. So when it comes to investing in a self-managed super fund, it means that the investment earnings, being in sense of property, the rental income gets, rather than being added to our assessable income, it's taxed in the super fund and taxed at a 15% rate. Now that can be
as opposed to 35, 37,
whatever our personal marginal tax rate might be. Now again, that might be a pro, but it also might be a negative.
Okay.
Because as you know, when we purchase property in our own names, the interest that we pay on the loan of the property becomes a tax deduction to us personally if we're owning that property personally. Whereas in a superannuation fund, the tax deduction for the interest that we pay is a tax deduction to the super fund and is a deduction at 15% rather than our personal marginal tax rate.
Okay, so you don't get the same negative gearing benefits.
Correct.
But on the flip side, if you end up selling the property or the property is positively geared long term, then you'll pay a lot less tax on it.
That's right. I do think that one of the pros that we didn't talk about was that if we hold a property until our retirement and then we sell it, the tax rate in self-managed super and in superannuation in general drops from 15% to 0.
So that's certainly a good advantage. And I guess property investment is a long-term investment strategy.
Yeah.
So if you are looking to buy an investment property and hold it for the long term, and then you want to sell it when you reach retirement age, then effectively you get to keep 100% of the profits. Whereas if you own it in another structure and sell it, then you have to pay probably a large sum of capital gains tax. So that's obviously a benefit.
I think, yes, it is. I think also it's important for us to consider some of the other negatives of self-managed super. One of the negatives is that a lot of times self-managed super is referred to as DIY super. So quite often our clients get a little bit frightened by the DIY aspects of self-managed super.
Yeah.
We try and alleviate that, but at the end of the day, there is more, with more control of what you're doing with your superannuation can sometimes come more effort and more work and more involvement in what's going on with your superannuation. So depending on how you sit, that might be a positive or a negative.
Okay, so I'm going to just summarise the pros and cons quickly. So pros are control. You're in total control of what you do with your money and how you invest it. You can buy property, so you can use your superannuation to buy an investment property, and you can use the power of leverage, I guess, to buy a bigger asset than just the cash that you've got sitting in your superannuation fund. And tax benefits. They're the main positives.
I think so.
On the flip side, the negatives could be cost, although cost could sometimes be a positive depending on the situation. Then you've also got, I guess, with control comes extra responsibility, let's say that, and obligation. So that could be a bit of a negative for some people depending on their situation. And I reckon, have I covered it all?
Yeah, I think so.
Yep, awesome.
We might talk more about investing in property in a self-managed super fund and the positives and negatives of that when we get a moment, but I'll leave you to guide me when you're ready when we talk about that.
Sounds good. Well, actually, Amelia did write in through the week, and she did ask the minimum superannuation, if there is a minimum superannuation balance that you need to have. Now, you've sort of answered that question from your perspective, Chris, and you said around 200,000. Is there actually a minimum requirement, or is that just a figure that you've...
Amelia, that's probably the most common question that we get asked when people ask us about self-managed super. What's the minimum balance that I need? And the answer to that is there's actually formally no minimum. There's a lot of different measures as to whether or not a self-managed superannuation fund might be appropriate for you. And the best way to determine that is just to seek some advice as to whether or not it's the right solution for you. But I think as a rule of thumb and as a guide, if you consider that somewhere between $150,000 to $200,000 is the right amount.
Yeah, and I also want to address that question, Amelia's question, from the perspective of lending. Because obviously, if people are setting up a self-managed super fund specifically for the purpose of investing in property, buying an investment property, then a lot of the answer to Amelia's question comes down to how much money do they need to have in their super fund to cover the deposit that they need to have to buy the property they want to buy. So, Kristen, can I get you to just address, what sort of deposit people need to have in their super fund for purchasing an investment property and how that all works?
Absolutely. So I guess there's a few different requirements from the bank's perspective. A few banks out there do have a minimum balance requirement before they'll even lend you any money, and that tends to sit around that 150, 200,000, depending on which bank you look at. So it's quite similar to what Chris has said. And I guess with regards to purchasing a property within super, the best way to get an understanding is to sit down with a broker and get a pre-approval done to make sure before you even set up the super fund that if buying property is something you want to do, that the banks will allow you to do that with your current position. But I guess just to throw some figures out there, most banks do require about a 30% deposit to purchase a property within super, which does differ a lot, where some banks will require as little as a 5% deposit to purchase a property in your own name.
So the 30% deposit, is there room to move on that? Like, there are some banks that will do lend a bit more than the 70%?
Absolutely. So it does really depend on your current financial situation. A few factors like your ability to service the debt. So if you have a really strong servicing capacity, some banks will lend you slightly more based on the value of the property. So it does really depend on your financial situation. But I think 30% is probably a good starting figure from the deposit side of things.
Because that actually, I remember that we got a question from Declan about a pre-approval, and he wanted to know whether that's a good idea and what the process of that involved in terms of finding out what you can afford and whether you need to have a self-managed super fund in place before you get the pre-approval, or whether you can get the pre-approval first.
Either way, but we absolutely encourage you to do the pre-approval first, just to make sure that, if one of the main reasons you're setting up a self-managed super fund is to be able to purchase property, you want to make sure that your circumstances allow that to happen, and the only way really is to have a pre-approval before going through the process of setting up the super fund.
Okay, so just to get this straight, so anyone that's interested in this can organise a meeting with a Rise High mortgage broker. They can find out their servicing, or they can find out their ability to borrow money through a super fund without actually having to go to any cost or any expense, and see if they can do what they want to do. And then from there, they can decide whether they want to set up a self-managed super fund.
Absolutely.
Yeah, okay. So can I just put you on the spot and throw some numbers out there? So let's just say, for example, based on what you said in relation to the 70%,
Yes.
If someone wanted to buy an investment property for $400,000,
Okay.
what would be the approximate balance that they would need in their fund to enable them to be able to borrow enough money to buy that property? Now I'm really testing.
I'm doing the calculations.
But Kristen's a Rise High broker, so I'm pretty sure she's pretty good on the spot.
So $400,000 property, the first figure we've just discussed is that 30% deposit. So $120,000 is the deposit that the banks will require you to put down to purchase that property. Now, with buying any property, you do have some stamp duty, government charges, conveyancing fees that are involved. So we say around $22,000 for a property worth $400,000.
So just over 5%.
Correct.
Yep.
Then there are some bank fees, of course, which do vary a lot from bank to bank. It is more expensive compared to buying in your own name. We estimate around $5,000 to set up the transaction. Now, a big portion of that is legal review fees, which is something that we don't have to worry about when buying in our own name. So that's another $5,000 for bank fees, give or take. Usually slightly less than that, but
so we're up to about 142 at the moment.
We're 147.
147.
Yes.
Yeah.
And the last thing to consider, which not all banks require, is something called the liquidity rule.
Okay.
So a lot of banks out there at the moment do require you to have 10% of the asset value. So if we're talking about a $400,000 property, around $40,000 left in liquid assets. Now what we mean by liquid assets is either cash or shares still sitting in your self-managed super fund account after the purchase of the property. So that brings us to about 187.
Okay, so
about 5,000 to buy a property worth 400,000.
Okay, so that's close to the mark of what Chris was saying. So to buy something for about 400,000, it's comfortable if you've got about 190,000 in your super fund.
Yeah.
Awesome. Now Henry did want to know. He has been reading and he heard that self-managed super fund loans are more expensive than normal property investment loans. So can you give us a guide in relation to, you've already touched on the fees, but just in relation to interest rates, like how much more are they, when you compare it to a normal investment property?
So I guess
loan?
When you're looking at current residential investment property, you're talking about 4.5% for a current variable rate. When you're looking at buying within self-managed super, the rate is about 1%, maybe 1.5% higher. So you're talking about 5.5% to 6% for the interest rate when it comes to self-managed super, plus the fees that I mentioned before.
Awesome. Now, see, we have Richard and Alison and Sue and Laura on the line. So thanks so much for joining us, guys. We hope you're enjoying the session. Getting back to the questions. So we had a question from Alice, actually. And you did touch before on the fact that normally it's sort of husband and wife or, family is a common sort of grouping of who would set up a self-managed super fund.
Yep.
Alice wanted to know, does it have to be husband and wife or can other family members get involved? And she also wanted to know if children could become involved in the self-managed super fund and at what stage or what age could they become involved?
Yeah, okay. So Alice
was
asking the question.
That's right.
Okay, so Alice, if you're watching live, the answer to the question is that most commonly it would be a husband and wife, but there is no rule that says it has to be a husband and wife. Essentially, it can be anybody, and it doesn't even have to be family members. So to give you a very succinct answer...
Does it have to be an adult over 18?
Yes, it does.
Right, okay.
So the answer to the question in regard to who can be involved, it can be anybody. So it can be you and your sister, you and your cousin, you and somebody that's unrelated to you. But when it comes to adding your children to the superannuation fund, you can't add your children to a superannuation fund until they're 18 years of age. Also, the other thing
once they're 18 and they're working, you can add them?
Yes, you can.
Okay,
yes.
great.
Now, it's a good thing to get a little bit of advice in regard to whether or not that's actually in your interest to do that. But setting that aside, of course, you can do that as soon as they're 18 and they're working.
Awesome. That's good. Now, I also had a question from Matt. He writes in because he has exhausted his borrowing capacity outside of super. So he's come to the limit of what he can afford and he really wants to continue growing his investment property. He hasn't explored self-managed super fund or super yet. So he wanted to know if he's exhausted his borrowing capacity outside of super, does that eliminate him from being able to pursue a self-managed super fund property investment, or can he still look into that?
Absolutely, it's still an option. So when the banks look at your borrowing capacity within self-managed super, they really take two things into account. The contributions that you've got going into your self-managed super fund.
So that's the contributions that your employer are paying into the fund?
Yes, correct. So if you're PAYG, it's your employer contributions, or if you're self-employed, they tend to look at the historical contributions that you've made into the fund. And the other thing they look at is the rental income that you've got coming in from your tenants for the investment property. So absolutely an option.
Okay, so that's good. So if you're only borrowing like 70%, you're going to need to be able to service that 70%. So the banks are actually using income that they don't take into consideration for normal loan assessments. They're using this superannuation
income. So if you can service that debt based purely on your super contributions and the rental income, then potentially, yes, that's an option for you.
Okay, great. Excellent. Something for Matt to explore. So Claire did ask about what is the cost of setting up and running a self-managed super fund. I feel like we've covered a little bit of that, but let's just summarise that for Claire quickly. So let's just talk about a rough figure for setup.
Okay, rough figure for setup is around about $3,500 to set up a self-managed superannuation fund with a quality deed that allows you to borrow in a self-managed superannuation fund. You can buy cheaper deeds but quite often you'll need to have them amended. Kristen talked about the fact that they are legally reviewed when the banks get hold of them. So a high quality deed is important. So about $3,500 to set up, Marissa.
Yep.
And then on an ongoing basis, depending on what you want your administrator to do, it's somewhere between about $2,500 and $5,000 a year to operate a self-managed superannuation fund.
Okay, beautiful. So hopefully that answers Claire's questions. Now, we did also have a question from Ben. He wanted to know what are the rules and restrictions about renovations and home improvements for investment properties that you own in a self-managed super fund.
Mm-hmm.
So Chris, I'm going to throw this one to you.
Yeah.
And this will be a nice one to wrap it up.
Okay, all right. So this one gets a little bit technical, so I'll try and be quite succinct here. The rules of self-managed super, or the rules of superannuation, say that you cannot substantially change the nature of a property that you've purchased within a self-managed super fund using borrowings. Now, what that means is that if you buy an old house and it needs a new kitchen and a new roof, that's fine because they're repairs and they're simply restoring the property to its original format. But if you wanted to take, for example, a 2-bedroom dwelling and change it into a 3-storey office, then that would be substantially changing the nature of the property and that would be prohibited.
So am I right by saying then that you shouldn't really buy a property that you plan to subdivide
You
or
can't
develop
subdivide. Yes.
in your self-managed super fund? It's probably not the right ownership structure for that type of property.
Yeah, that's correct. So the notion of substantially changing the nature of a property doesn't just mean its physical appearance. So if we're changing the title from being a single title to subdivision, then that's substantially changing the nature of the property as well. So this is an area where I recommend you simply give us a call and we can provide you with some advice in regard to what you can and can't do.
Awesome.
Yeah.
Look, I think we are running out of time, so I'm just going to quickly wrap it up by saying that it is a fairly complex area. There are definitely a lot of really good benefits and advantages of considering property investment within a self-managed super fund for the right person.
Mm-hmm.
But I think it is an area that you really need to get some specialised advice on. So the team at Rise High are always available for free consultations to discuss it further with you. I'm also going to throw it out there, Chris. Will you offer our clients a free consult if they want to have a chat? Okay.
Absolutely, yes.
So you
we're
can
happy.
contact Chris at Excel Super, or you can get his details from us and we'd be happy to pass them on. But he has just said on Facebook Live TV, that he's happy to offer a free consult. So you've heard it here. So take advantage of that because he is very knowledgeable and we would love to help you if you are interested in this area. It's not for everyone, but for the people that can benefit from it, it's really good. So just before we wrap up, quick reminder, our last property seminar for the year is the 14th of November. Go to risehigh.com.au to register and secure your seat now. And if you're interested in property investment, hop on to risehighinvestor.com.au and check out the book. And it is on a special price at the moment, $14.95 for pre-order. That price is only around for another week or so. So definitely check that out and grab yourself a copy. Thanks so much for tuning in tonight, and we hope you got value out of the session, and we look forward to seeing you next time.
Bye, Mum.
Thanks.